Hello and welcome to our discussion on accounting. We'll continue our discussion on cash flow statement. Um, so we have seen that whenever there are financial statements, when you see in an annual report, you see the opening balance sheet given, you'll see the closing balance sheet given, and also the corresponding income statement and a cash flow statement. This completes the cycle, that opening balance sheet, closing balance sheet, income statement for the year, and cash flow statement for the year. What we will try to see today, that when the opening balance sheet, income statement, and cash flow and closing balance sheet are given, we can prepare the cash flow statement for the period. So let us take an example to understand that. So let me take you to an Excel. If you see here, the opening balance sheet is given, the closing balance sheet is given, the income statement for the period is given, whereas the cash flow statement is not given. For the time being, ignore all these items. Okay, I'm removing this. So if you want to prepare a cash flow statement, either you can start with the income statement or you can start with the closing balance sheet, and you can see the changes in the form of the cash flows. So in this exercise, let us start with the sales or income statement. So there is a sales, but the corresponding items to the sales are the debtor. So therefore, let us find out as a working, if there is a debtor, the opening debtor was, these are all workings, okay? So opening debtor was 200. I assume that the entire sales is credit sales, okay? So if entire sales is a credit sales, then less collection will give me the closing debtors, and the closing debtors is already known. So that means the balancing figure, which is opening plus the sales minus the closing, is collection for the period. So therefore, that is a cash flow item. So the collection during the period is 1500. Okay. So therefore, that means you can see that this much of sales has happened, but their debtors has increased, so therefore that's a collection. Now let us see, then the next item is the cost of goods sold. So the cost of goods sold relates to the stock, and the stock is related to the creditor because you may purchase the stock on credit. So it is always advisable to understand the stock and the creditor together, so that you'll know how much you have purchased and how much did you pay. Okay, so how much you purchase and how much you pay. So let me slightly reduce this size. Okay, it's alright. So the opening stock, you had an opening stock was 150. 150. So add purchases during the year, we don't know how much, less COGS, which is known. COGS is 655. Then you have the closing stock, which is there in the balance sheet, 295. So the purchases during the period is 295 plus the opening plus the cost of goods sold minus the opening stock is the purchases. So that means during this period you made a purchases of 800. Okay, so let me close this. Okay, so 800 million or crores, whatever is the number, and let us assume that this purchases is for credit. So I'm assuming that this is for credit. Why it is necessary? So that will be useful when I see the opening creditor. The opening creditor was 100. Add purchases, which we just now got, that is 800. Less payment will give me the closing. Closing is already there, 40. What does it mean? So we can now find out the payment during the period, 100 plus 800 minus this. So this is the payment that you made during the period. So in the cash flow statement, we'll say payment to the creditor is 860. So the payment coming from that worksheet. Similarly, the collection is coming from the debtors worksheet. So that is why these worksheets are very important. Okay, so let us move ahead. Payment, so payment to the creditor, payment to the creditor is. Now just see the operating expense. Operating expenses for the period is 395, and there was no outstanding operating expense during the period on the balance sheet. That means the entire operating expense has been paid. Otherwise there would have been an outstanding operating expense. Depreciation is non-cash item, so it will not come into the cash flow. Interest is a cash item. Once again, I show the interest as an outflow or a payment because there is no outstanding interest in the balance sheet. Tax also I paid because there is no outstanding on the sources side as a payment. Neither you paid more also. And similarly, let us see the plant. So there was a change in a plant. So first let us understand why at all the plant will change. The plant will change if there is a purchase. Plant will change if there is a depreciation, so that the balance will be the closing. So let us see whether there is any purchase. So plant opening stock of the plant, you don't know about the purchase. Depreciation is 40. Okay, depreciation is 40, and the closing balance is given 310. So therefore the balancing figure 310 plus 40 minus the opening stock will give me, that means during the period you made a purchases of plant to the extent of 310, and since there is no liability to that extent, I'll say that I purchased the plant of 200 during the period. So now we can add up all the, you can see there is capital has not changed. You can see that the loans have not changed, and the reserves which has changed, you can see that entire reserves, the reserves has changed only because of the profits. So entire profit has been retained. So therefore there is no cash outflow because of the payment of dividend. Since all items are taken care, so we'll say that the total of the payment, okay, total of payment is 162. The total of inflows, okay, so there was an opening cash plus collection minus the total payment. Okay, so the opening cash was how much? 300. So you can see that 138, we have arrived at 138 in a cash flow statement. So cash flow statement can be prepared if there is a opening balance sheet, closing balance sheet, and income statement. But in one of our previous sessions we discussed that it is not enough to show the cash flow statement as a receipts and minus payment. It is necessary to show the cash from operation, cash from investment, cash from financing. So cash from operation is a collection minus the payment to the creditor minus the operating expense minus the tax. Okay, so cash from operation is collection minus the creditor, payment to the creditor, minus the operating expense, and minus the tax is the cash from operation. Now cash from investment, you have not received any other inflow, so the only investment decision that you made is the acquisition of a plant, so therefore there is a negative cash from investment. In the same way, you have not raised money or borrowed money, so the only payment is the interest payment, so therefore the cash from financing is negative. So CFF negative, CFI negative, CFO positive, so together you'll get the cash in hand, which we got already previously as 138. So that gives us an idea that the balance sheet, if the balance sheet is given, if the income statement is given, we can prepare the closing balance sheet, and we can also prepare the cash flow statement. If one of the financial items are missing, you can prepare them if other three are available. So that is the cash flow statement if income statement and the balance sheet is given. But let me continue the discussion here. So we got a direct method of cash flow. How was that? Let me show it once again. Collection. Okay, I think better let me be consistent. So collection, you made a collection, and how much was the collection? 1500 less the payment, creditor. Okay, creditor, payment to the creditor 860, payment towards operating expense is 345, payment to the tax, payment towards the tax, and payment towards the tax is 237. So therefore the cash from operation will be will be minus 237.58. That is a direct method which will show the receipts and payments coming from the operating activity. But indirect method, as we know, will show that why is the PAT not same as the CFO. So therefore indirect method reconciles PAT with CFO, and we have seen in the past it is because of depreciation and amortization. The depreciation is 40, is a non-cash. Interest is a non-operating. I add them back. Then working capital changes. Okay, working capital changes, and working capital changes means debtors. You can see that increase in debtor. Okay, the debtors increase means you are selling the goods on credit, so you are not going to get cash, so minus 350. Increase in stock, that means you purchase the goods on credit more than what is required or more than what has been sold. And decrease in creditor. Okay, decrease in creditor, that means you paid money during the period we'll take care of that. So decrease in creditor. Okay, so decrease in creditor. So if I sum them up together, if we will get the cash from operation. So let me summarize. So if the balance sheet is given, opening and closing, if the income statement is given, it is possible to prepare the cash flow statement. And if the cash flow statement is receipts and payments are there, you can also find CFO, CFI, CFF. CFO can be prepared by using a direct method, or CFO can be used by preparing an indirect method. The direct method shows the operating receipts and operating payments, okay, and the indirect method will adjust the PAT to arrive at the CFO. In other words, it answers why is PAT different from CFO, or why is CFO different from PAT. In one of our future sessions, we'll see when the balance sheet and cash flow statements are given, how to prepare the income statement. But in this problem, we saw if the balance sheet and the income statements are given, how to prepare the cash flow, statement. So once any of the missing number or any of the missing financial statements can be prepared if three of these balance sheet, income statement and cash flow statements are given. Thank you very much.